Just a couple of days ago, Bureau of Labor Statistics issued the long-awaited CPI report for May. And while the April numbers were somewhat promising and many expected even better numbers for May, it didn't quite turn out to be the case, because the May numbers were even worse. CPI rises 1% compared to 0.3% in April, with main drivers of course being food that went up 1.2% compared to 0.9% in April, shelter that went up 0.6% compared to 0.5% in April, and of course the energy sector that went up 3.9% compared to minus 2.7%, with the major driver of course being the gas prices that went up 16.9% compared to 2.7% in April. I personally felt that because what used to cost me like $65 just a couple of months ago to fill up my whole tank now costs me $80 here in Texas, and that's just insane. So where does it leave us and what to expect? A lot of people hear about Fed raising the rates, but what does it actually mean and what should we fear? And I also see a lot of people confusing inflation and recession. I also saw a spike in recession search term recently, which probably partially due to the fact that people mix up these two terms. So let me explain. Now, there are a lot of factors that contribute to the current inflation levels, but in my modest opinion, the main one, of course, was the pandemic that hit the production facilities, meaning it was harder to produce stuff due to the lockdowns, and later on it got harder to deliver this stuff from the manufacturers to retailers, which of course already shifted the supply and demand equilibrium. And then there were several rounds of stimulus checks, which in itself already makes the dollar weaker because there is more dollars being printed, meaning each dollar is worth less now. And the fact that people now have more money to spend, with the supply being so short and the demand being so high, with all this extra cash being printed, that just added up even more, and we are where we are now. And that is inflation when prices are going higher. But now on the other hand we have recession, and what recession is a macroeconomic term that describes the decline in the economic activity of a designated region. And that macroeconomic activity is measured in GDP, or gross domestic product, which is a comprehensive measure of US economic activity that describes the amount of goods and services produced in the United States. And that's exactly what happened during the recessions in 2007 and the early 1980s, when we saw the decline in GDP of 5.1% and 2.7% respectively. And after seeing an increase in GDP throughout 2021, the Bureau of Economic Activity issued the second prediction for Q1 2022, and that prediction states that we have a decline of 1.5% for the GDP, which means that the next prediction is going to be even more crucial, because if we're going to see a decline in the prediction for Q2 of 2022, that might already show some trend, and it might signal that we're entering the recession. So then why inflation is not the same as a recession, and how they connected, and why the next Fed meeting is so important? You see, the previous periods of recessions didn't always have high inflation. Yes, in 1980s we saw inflation rate of around 13%, but during the recession of 2007 we saw the inflation rate being around 2.5 to 3.5%, which is somewhat normal. What caused the recession in 2007 was the housing bubble, but we all saw the inflation being around normal. But early 1980s recession is probably more relevant to what we see now, because early 1980s recession was actually caused by high inflation that led to tight monetary policy. And what is tight monetary policy? Tight monetary policy is the action taken by the central bank, which in our case is Fed, to reduce the economic growth. And the Fed does that by raising the Fed fund rate, which makes it harder for consumers to borrow money to purchase stuff. So they raise the interest rates, which are later on passed to the consumers through other financial institutions such as credit unions and banks. And now it's harder for us to borrow money because it leads to higher mortgage, higher credit card, higher auto loan rates, and so on, which should slow down the spending, aka the demand, because now it makes it less affordable for people to borrow money to spend, which in turn should slow down the economic growth, because less purchasing power means less business. It also means less revenue for the businesses, which in turn leads to slower cash flow. And that's why the next Fed meeting is extremely important, because we were expected to see about 50 basis point increase, but with the recent CPI report and inflation numbers, it might probably go higher, up to 75 basis points or maybe even more. And the Fed now has a really difficult task because the market is waiting whether the Fed can tame the inflation without dragging the economy into the recession. If they bump that rate too high and they keep it that way for too long, then we might see some signs of recession sooner than later. And that was supposed to be just a short video to give you some understanding what is inflation and what is recession, how are they related, and whether it's the same thing. And I hope it was informative, and if you enjoyed it, please give it a thumbs up for YouTube algorithm. And if you want to see more stuff like this where I talk about economy and finance and investing, then please subscribe to my channel down below and hit notification bell to get notified next time a new video comes out, and I'll see you all on the next one. Bye.